My name is Abhishek Moran, and I've written The Fundraising Blueprint, a guide to raising capital with confidence and an insight into the hidden nuances of the venture capital world. Since 2019, Eucalyptus has followed the quintessential venture fundraising pathway. They've raised $100 million across 5 funding rounds from Australian and American investors, and done so in a way that not many Australian startups have before. Today, we've got Tim Doyle with us on the podcast, who's eager to share everything he knows about fundraising, including the tricks and tribulations of dealing with investors, forming a board, and what actually sets early stage founders apart from the rest. Here's my conversation with Tim. Today, we have Tim Doyle, founder of Eucalyptus, here to share the last 5 years of fundraising, $100 million plus from global investors and everyone in between. I think you guys have had probably the quintessential funding journey for a venture-backed startup.
Yeah.
But weirdly, not really like a linear business building journey. Like there's a few different elements and all of that. And so I really want to unpack a bit of that. But first, let's start off with maybe off the top of your head, what's been like the weirdest fundraising interaction with the VC, or the craziest, most outlandish, something like that.
Most outlandish. I think like it was a real experience the first time I went to San Francisco fundraising, just because of the just the amount of money that's there, and then for the behavior that drives. Like I think I'd been in a meeting with a particular kind of Series A investor during the day, and we'd spent like 45 minutes together, and I didn't think it went that well. And then I went to a drinks that night, and he just like fully blanked me at the drinks, like just fully like we'd never met, and just like looked at me and just turned and looked away. And I was like, oh, clearly like I'm not up to that whatever that is, I'm not getting that. And so like just the like Australia's small and much more networked, I felt. And so the incentives to like disregard people are pretty low. But in the US it's a completely different game.
It's just like, I guess just the volume of capital there, the number of startups that they're meeting on a daily basis and all of that.
Yeah, for sure. Like a lot of the niceties just disappeared. I certainly wasn't ready for that.
You made some really viral comments about window washing. What would you say differently this time around?
I think one thing that's really important is understanding what shape your business needs to be in at certain times. Yep. So like the way that I would think about it, and I would choose more selective language if I were to go through that moment of my life again, is it's almost like preparing for like a competition, or like the crudest way to think about it is like, I think of it as like a bodybuilding competition, where it's like people don't spend the entire lead up to that extremely ripped, right? Like it's like you make certain decisions on like lengths of return from a capital perspective. So you might do more marketing in the 6 months before a fundraise. You might hold back hiring. You might like make a whole lot of suboptimal long-term decisions in order to have the best business in the best fundraising shape possible. Sure. And then you present that shape and that narrative, right? So it's like, I think there's an understanding of timing that comes with A, getting yourself like fundraising fit, and B, then reshaping the story around your business for the next 2 years to 3 years of growth, and so that you have both a fit business and a clear path to growth when it comes to like the action moments of fundraising.
I think you got into some really interesting threads about timing your fundraise. How did you know to do that?
Early on, so Eucalyptus has never been the shape of business that is particularly attractive from a like unit economics perspective to most funders, right? Like, so I think like, being a D2C business, being in healthcare, moving physical goods, multi-brand, multi-market, not global from day one. You kind of have to really think about what the value proposition to investors is and why they should believe in the thing that you're going to do. Yeah. And so unlike SaaS businesses where like you prove the economics and then you pour money onto scale, we knew that we were going to have to be different businesses and solve different problems at different stages for us to even be a successful business. And so like in my mind, I had like a plan for what the different stages might look like. On the journey to building, a multi-billion-dollar business, hopefully. And so I had that like intuition as to what the stages was, and then I put a lot of effort into shaping narrative around those stages.
Did you have framework for that narrative, or like did you have?
I think there are really simple ways to think about it. Is so going into a conversation with a VC or just with kind of any fundraising source generally. You want to present a fund returning scale outcome. So you want to be really clear about what the $500 million revenue plus business looks like. Then you want a really clear view of the unique insight that says that you will be able to win in this category.
Yeah.
There are many forms of that. Ours initially was team.
Yeah.
And then you need to be able to show a really clear path to a next fundable milestone.
Sure.
And so like with X dollars, we will get to Y point. And then actually fidelity between those landmarks is actually not very important at all. What I see a lot of people do is they bang heaps of detail about the business plan and things. None of that actually matters. The software, none of that actually matters. It's like one fundable milestone in the future and a path to a $500 million revenue business. And the rest is, and a unique insight. And then the rest is all up for the conversations that follow.
Yeah. And I guess for the conversations that follow, how did you manage that with investors? How did you think about investor bias and shaping the narrative around that? Or did you just disregard and kind of
no, you can't. I don't think you can disregard. I see a lot of companies go into fundraising conversations naive to the biases that are going to exist. And I think what we tried to do with our unique insight at every point was say, hey, we understand that businesses in this category fail for this reason.
Yeah.
Here is the insight that says that we can get through that. And, you know, like the first version of it was the team that we thought we could bring together. The second version of it was multiple brands as places to deploy capital, meaning that individual brands didn't suffer the same strain as kind of normal D2C businesses.
Yep.
And then later than that, it was kind of more about what individual brands that we had could become as part of a path to a broader health platform. And that's why, like, so basically, like, if you look at Eucalyptus now, the funder skepticism or bias would be that very few people have actually been able to build high touch cross-sell oriented experiences in healthcare. And so the counter argument that we have to make to that is like, A, there's never been a moment like now. And then B, that because of what we've done in obesity, we have a fantastic high touch relationship with patients that can be a wedge into more.
For sure.
And so that then the conversation centers around that.
Yeah, I think that's really interesting. And the one thing that's probably more pertinent now than ever before is like the topic of competition. At the early stage and even at Series B, C, where you guys are, there's competitors everywhere and it's becoming easier, or the barriers to entry to getting into the market is easier. How do you deal with that? How do you deal with the bias there?
So something that I often say to people is like most companies are only really good at one thing.
Yeah.
And so like you should only really listen to advice from founders about the thing that they're world class at, but from an execution perspective. And for a lot of them, like that is software building, but you know, for others that's design. It might be whatever it is, but understand really, really deliberately what your thing is, and then how that gives you competitive advantage.
Yeah.
And so like, I would never say that like Eucalyptus is one of the great software building companies, because it's not.
Sure.
But you know, when it comes to like building highly retentive, like essentially communication experiences or marketing experiences, like we're really good at that. And so when we talk about competition, we talk about how we win on that, and then how that creates space for us to be the median company across a whole lot of other things.
Yeah.
And that can still be a great company.
So I think you spoke a little bit about sort of, you know, the different pivots you've made from a business perspective or the different approaches. How did you sort of, you know, manage existing investors through that process, but also to communicate those changes without making them sound like negative or business ending or whatever to prospective ones?
So I said to Nick, the partner from Blackbird, who's been an investor with us since our first money in, I said recently, as we were talking about another fundraise, is that like Eucalyptus has always been framed in our board context as like a bit of like a lily pad business, in the sense that like it jumps to a new opportunity, executes at that new opportunity, jumps to a new opportunity, executes at that new opportunity. And so it's not necessarily about being really clear about where the next like lily pads actually are. It's more about having a really great engine for the jump and then being able to navigate when you arrive. And so there is a level of comfort in uncertainty that is built into the business that we have a track record of succeeding against.
Sure.
And so when it comes time to take on more uncertainty, we can point to our backstory of being able to do that and go, here's the path that we've taken.
That makes sense. And I think that it's a tricky one, at least from my perspective, in terms of how you actually forecast the capital requirements there. How have you thought about that?
So, I mean, there's a lot of complexity there. I think like capital requirements are like fundamentally down to which bets you're willing to take and how much you want to spend on them and how likely they are to return and on what timeline, right? So at any given time, we will arrive at a new fundraising kind of milestone or destination look at the capital markets generally and go, what do we think we have access to? And then kind of build a series of bets around that.
Yeah.
And examples of bets might be new countries, might be new conditions, might be new technology. Think of the hiring plan and the risk associated with that. Then kind of sum those together to get a view of like, probably about this and this many bets. Then pull those bets together into a narrative. And then that narrative kind of informs the fundraise.
Yeah.
So and then to bring that into a really tangible example, like if we were fundraising right now, we would be super aggressive with the number of bets we were thinking about doing.
Sure.
Because the business is performing really well and there's strong reasons to believe that like the capital availability is there.
Sure.
When we last fundraised, which was at the beginning of 2023, completely different market, right? And so what you're actually doing is presenting like a relatively low creativity, high execution narrative that has no new bets, but rather continued execution of the thing you're already doing.
Yeah, that's super interesting. Taking a bit of a different turn, how do you test for investor conviction when talking to them?
I don't think it's like a particularly strategic thing that you're doing there, or like clear thing. It's like these conversations feel very natural, and then you feel like there are behaviors straight after the meeting that indicate conviction, right?
Yeah.
And so like once you've done 1,000 investor meetings, which I definitely would have, you start to get a feel for like whether or not these people are legitimate and serious pretty quickly.
Sure.
And like things like speed of follow-up, things like depth of question, things like understanding of the business model, they all are precursors to serious levels of interest. And actually any of those being absent, you very rarely see an investor turn around. You very rarely see an investor slowly warm up.
Sure.
It's much more that they go from warm to cool.
Cool. Yeah, makes sense. And does that sort of translate across different geographies as well? Like what are the nuances between raising from an American VC versus a non-American one?
I find this this like narrative around Australian VCs being more conservative or different in some ways to mostly not be true to my experience.
Okay.
I found that the big Australian VCs have largely been as aggressive, if not more aggressive, particularly at the early stage than their American counterparts.
Yeah.
Obviously, I can't speak for all investors, but let's talk the 3 to 5 big funds that there are. But I do think that Australia doesn't really have later stage VCs. Yeah. And so from the time we raised our Series B, so we've raised a B, a C, and a C1 because who cares about naming conventions anymore? I think you get into a different type of mindset with the investor, which is a much more financially oriented conversation. Sure. And none of the Australian VCs do that financially oriented conversation particularly well.
Yeah, interesting.
And so you end up having a much more detailed analytical discussion about things like the market and things like kind of your unit economics and competition that tend to anchor more around financial models than they do around narratives.
Sure.
And so that is a big jump that you make, but it happens kind of from what I would call, like if you call seed investors like largely people-based, Series A investors largely idea and market-based, but pretty vibes-based, and then growth investors largely financial model-based. The biggest thing you notice is when you go from the Series A investors to the financial model-based investors, because you just a completely different style of conversation.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for global frameworks like ISO 27001 and SOC 2 and the latest Australian frameworks like the CPS 234 and Essential 8, saving you time and money while helping you build customer trust. Over 10,000 global companies like Atlassian, Handle, FireAnt, Indebted, and Tactic.io use Vanta to manage risk and prove security in real time. Start with Vanta's ISO 27001 compliance checklist, which breaks down the process into clear steps, so you can spend less time on compliance and more time growing your business. So you've kind of raised through 2021, 2023, 2024. There's different incentives and biases on investors and forces on investors to guide their decisions. How did that work for you?
Yeah, it was like such a drastically different experience one year to the next. And I mean, people often talk about this, but we raised in 2021, at like a 10 times revenue multiple. We raised twice that year. We raised I think $90 million in the year.
Yeah.
It was reasonably easy to do so. Terms were very competitive. Things happen very fast.
Yeah.
Then middle of 2022 comes, and like you can feel the market sentiment changing, and you can certainly hear it from our board, but we're growing really quickly. So, and the business has been built to grow. Like the entire infrastructure is there for fast growth. And so you're like, oh, do we have to change tact? Do we have to change tact? And like before we decided to change tact, we were like, well, let's get some debt into the business to give us time to change tact. So we did that. And then like the debt kind of DD period dragged out and was pretty painful. And then on the last day of the DD period, they pulled the term sheet. Which means that like we were burning, I think, let's call it somewhere between I can't remember exactly, but somewhere between $3 and $4 million a month at the time. And had to get to realistically sub $1 million of burn within 3 months. And so that just meant that like the bets, we were talking about bets before, we were just cutting bets left, right, and center. And then that obviously meant to having to cut staff and do redundancies as well, which is like super painful. But I think like, as I reflected on in the context of the fundraising process, it's like I've been through a couple of changes in the market mood since then, and you've just got to really be willing to change your own risk appetite alongside the market and change quickly.
Yeah, interesting. And how have you been able to change quickly?
I think like it's having a really good understanding of what bets, like capital allocation is so important inside a business, right? And so having a really good understanding of what bets you're taking and what timelines they're going to return on and the risk associated with them. And then knowing that like, on the capital we have now, we can afford to have 3 bets going. And then with more capital, we can have more. And here's the ones we would cut if we needed to cut.
Makes sense.
Like it's so, so important. And I think what's massively misunderstood, particularly I think in Australian founders, is that like there's a naivety around being able to do all the things. And I think like that is really painful and a dangerous position to get yourself into.
Why do you think that's the case?
I don't think we have a great startup and growth stage CFO cohort. From what I've seen from US based, so my experiences of CFOs are we had Alexi at the start who had been at Canva and at Koala with me, and he was fantastic, and so kind of put financial discipline into the business early. That then led to us being able to build a good finance function. But then I when he left, I went through the process of interviewing probably another 100 to 150 CFOs to fill that role, and just was amazed by how little understanding of growth there was. There's great accountants out there, and then there's great kind of steady company finance managers, but the like risk on capital allocation based role that like a growth stage CFO needs is just so rare. And so I've probably met 3 or 4 in Australia, and then it's such a more known skill set in the Valley that I think you get a lot better at it there. Yeah,
that's really interesting. And I think like at the early stage, it's a bit tricky because the founders coming through at that stage haven't necessarily been exposed to this stuff. Do you have any advice for them to like, what should they expose themselves to, or what should they learn?
I guess I don't think you can build a $10 million plus revenue business, so relatively small, without a good understanding of finance. I think it just becomes so much of what you do, and not in the bookkeeping context, but like in the context of like, how are we going to grow and how are we investing into that growth? Only the best companies don't have to worry about that because the growth looks after itself. But for everybody else, I think like it's the number one survival skill that you need. And I think it's like, I find it a little bit naive that people are less willing than I would hope to take it on.
Yeah, that's really interesting because I mean, it feels like the fundamentals of business building. Right?
But I mean, you see decks all the time, right? Where it's like the financial models are like sell perfect and sheet ridiculous, and it's just like, what's going on here?
Yeah, I think that's an interesting one in terms of like presenting forecasts, for example. Like you said, I see ridiculous forecasts all the time. It's kind of like either super conservative or super bullish and like hardly anything in between. Like, how did you think about that for you, especially when you are placing bets all over the place?
Milestone based. Like it's just so important to have a really clear view of where you're trying to get to in 18 months to 2 years and be reasonably clear about the growth levers that you have to get there. And like obviously in my business, it's actually relatively simple because it's mostly either new brands or marketing spend that dictates the growth rate. For more product heavy businesses, you have like the returns on unknown product investments. But I think you've got to forecast those in like, you've essentially got to have a base and stretch case in most of those scenarios. You've got to be saying like, hey, if this goes okay and doesn't work, it'll be like this, and that's fine because the business will be live and we have other ways to grow. But if it works, it will look like this, and then we'll fundraise at the top of the curve.
You sort of spoke about, the debt deal sort of falling through and a bit of difficulty through that fundraising period. Like, what have you noticed between like really helpful investors versus like time wasters?
So there are different types of useful investors. I think at the junior levels, there are only really one type of useful one, the ones that are willing to get in the detail and do the work and then kind of present information based on what they see. So like the best junior investors I've ever worked with are the ones that like know the finances of the business better than we ourselves know them and are willing to be like, ask good questions based on having thought deeply around the business and then have relatively low ego about those questions. I'd imagine like you've probably seen similar, right?
Yeah. I think it's like, I think my role as a junior investor is, one, digging into the numbers, knowing it better than the founders. And then two, like being able to identify the things that actually matter about the business. Like you've spoken about the growth levers and the crucial like growth leaps that you need to make through the business building journey. And, some businesses it's easier to find that and some businesses it's harder, but it always helps if like the founder can kind of guide you that way so you understand what their assumptions are.
Yeah, for
and
sure.
then from there, it's my job to dig into that and like.
And I think the shared language of that dialogue has to be a good understanding of the numbers on both sides for sure.
Yeah.
And then I think when you talk about partners in VC firms or more senior investors, you're talking about like their ability to extend their pattern matching history to your context and see things ahead of you that you don't see. So the best ones that I've seen at that level are completely different. They're not in the detail particularly much, but they go, this category is shaping out this way and I've seen this before and therefore you should do this.
Yeah.
And I found it's a rare skill. It's also where there's the most room for error because often people think they're at that level, but they're not. And so they're the most dangerous VCs.
Sure.
But when they're great at that pattern, like the ones that you hear about the globally best VCs, that they tend to be like that, of that style.
Yeah. And I guess like drawing that further, how did you think about building your board or sort of surrounding yourself with those types of people?
I wouldn't say we've been particularly intentional about how we've built out the board or the advisors around that. I think like the reality of fundraising is that it is part of the negotiation as to getting to the dollars into the business. And that's the primary thing that you're looking to do.
Sure.
And then you deal with the kind of consequences of that from a board structure and board quality perspective as a result of that. And so we've been lucky to have some really great people join at different points in the life of the business. But I think only now are we really starting to be intentional. So we've brought on like our first independent maybe 12 months ago. And we're starting to chart the path to a mature kind of public company ready board over the next year.
Cool.
But I wouldn't say that like I've been able to tactically balance skills on the board over the last 5 years. It's just whichever investors have come in with what rights at what times have dictated that largely, which means that you don't have, the greatest of insightful relationships with that group, but that's okay. Like it is what it is. You've got lots of ways to get that.
Sure. Yeah. I think that kind of makes sense. And thinking through the negotiation of a deal, what sort of terms did you think about, or especially at the early stage when maybe there isn't too much to the business? How did you think about pushing back with investors?
It's so hard, right? Because at the early stage, I was so lucky to be surrounded by people who had done it before, and particularly from Alexi, because I had no idea. And then Blackbird acted with integrity in times when they could have fucked me, but I had no idea that they had that opportunity at the time, right? So our situation was that we raised $2 million and then we got kicked off Stripe because of just some complexities around processing payments for pharmacies in Australia. And we were about to run out of money, and Blackbird kind of wrote a very clean extension to that, another $1.5 million. And I had seen in other situations where you get all types of terms put into those kind of predatory term sheet stages where you have like, I mean, the classic ones are like liquidation preferences, right?
For sure.
Or
anti-dilution.
Anti-dilution, right? And you see either of those two provisions there and you're like, oh, this is a path to this business actually dying. And so like cleanliness above all else, but also it can be hard. Like I get that you don't always have options. And so like we've been lucky because apart from that one example, we've had competition at the term sheet at every round. And so then you can just rip stuff out of that term sheet. But,
for sure.
But that's not necessarily there for everybody. And so I don't think there are hard and fast rules, just hopefully in line incentives with the people that are funding you, and try and remove protections on the downside.
Yeah. I think that's an interesting point around aligning incentives. How did you think about that within the construction of your cap table? Small funds, big funds, everyone in between.
Yeah.
Was that intentional for you?
Again, like it's really hard to be intentional on that, right? Like I think I'm feeling it now where we have investors that are, up 50x on Eucalyptus and have been in since the beginning, and it's now a life-changing amount of money for them. And so any path to liquidity is a good path versus some of our funders are probably sitting on 2 times and, need to see it go 2 times again. And you can sense the differences in incentives when you have those discussions. Even funds where we're a small part of the fund versus funds where we're a large part of the fund. You can sense that difficulty. And so I think like, the only real counsel I can give is like awareness of that, not necessarily like that there is a really hard and fast way to negotiate it. Just like it is there. And people are people in that sense. And, it matters at different levels to their careers.
Absolutely. I've seen it manifest in like pretty terrible ways where it's like blocking an exit or blocking a liquidity pathway that could have been really beneficial for a founder, for example. But you're right. Like there isn't a lot you can do, especially at the early stage. It's more about knowing it exists, being aware of it and all of that.
I think like the only thing that I think is redeeming in this kind of world is that reputation echoes for a long time. And so if people act against, like often small companies have no leverage, but their only leverage is their ability to talk to other small companies. And so hopefully most people on the investor side, particularly funds, they realize that, like nickel and diming for the last couple of $100,000 that are available in a dying company is not worth it relative to the reputational damage can be done on the next deal. Like I think like some of the early, mega successes of Australian startups had some pretty toxic behavior in their early fundraising rounds.
Absolutely.
And that echoed through the returns of those funds for the next 10 years. And I think that's probably the lesson.
Yeah, that's an interesting one in that I kind of think maybe that behavior has swung really to the opposite side where now investors are just preserving optionality everywhere, where it's like, okay, founder friendly terms, great, that's good. That's kind of like your must have. But also it's like not really harsh feedback for founders or being really like wishy-washy in terms of like your engagement with the founder and that sort of thing. It manifests in like terrible ways.
My take on that is know where you sit in the fund, because if you will feel personally like $1.5 million is a lot of $1 billion fund or a $500 million fund. It's not, right? Yep. And so like they will place these seed bets and then only really start to care about you when you raise an A. And like, that's fine. That's the way it is. You've got the freedom to spend that $1 million. So there are kind of a couple of lessons there. They were like, don't expect them to get a whole lot of feedback from them. Don't expect to get a lot of help from them. But also, don't really worry too much if that $1.5 million, like be as risk on as you can be with that, because like the thing that I see heaps of is like companies that were like funded $1.5 million out of a great VC fund, down to their last $500,000. It's clearly not working. And they're like desperately fighting to survive. Mostly for reputational reasons. And I'm like, nobody's going to care. Like, let that go. Like it'll be fine. When companies are down to their last $500,000 and the first $1 million of bet clearly hasn't worked, I think like often the best thing to do is to take a moonshot there. Have a crack at something completely new, rather than desperately claw your way out of the thing, because it's just so rare that works. And honestly, the impact for the fund itself is not going to be life or death for them. And I think like the freedom to actually realize that you're not that important in the context of a VC fund is actually very freeing. Like even at the Series A for us, I was like, if this goes to zero, it's probably not the end of the world for any of the funders. Now I'd be a little bit more concerned. But yeah, I think like early stage companies need to realize that a little bit.
I think that's a really interesting one where, let's say you had a smaller VC fund on your cap table and like the $1.5 million actually matters to them and they're kind of guiding you to this path of profitability.
They shouldn't be writing seed checks.
I think that's a fair take.
Well, they certainly shouldn't be writing $1.5 million seed checks. Like if they're going if they've got a $10 million fund, write $25,000. Like that's on the fund for fund construction being a mess.
Yeah, I think that's fair. I guess, how do you think about that from a founder perspective where, okay, down to the last 500, the conventional wisdom is like, okay, shoot for the moon. It's what we're doing in venture. But but there's something in you that's like, oh man, I just need to keep this business alive, just eke it out, and maybe something will work. Like, how do you think about that weird like mental challenge?
Yeah, I mean, like there are better people to give advice on this than me because I haven't really lived through that. But I think it seems when I've heard people speak about it, like the separation of their own identity from the business, it feels like a big challenge and very important. And I think like that's what frees you to do that.
Yeah, that's fair.
You obviously see all the tropes around VC advice to founders at the early stage about how they should fundraise. Like, what are the things that people get really wrong?
Yeah. I think what people get really wrong is one, the timing piece that we kind of spoke about before is very much like a lot of them come to me where either they don't have a lot of money or they're running out of money and they're like, oh, I just need like $1 million to survive a bit longer. And what you were saying about, not like driving to a milestone, they just don't have that. And I think that's what really frustrates me because whatever they're building, it's just kind of for nothing. Like there's no end goal there, or the end goal is actually just like a bit of tangible.
Yeah, fundraising can't be to survive, right? Yeah, of course.
Exactly. So like that's one big thing I see at the early stage. The other one is probably thinking through like the leaps between what we're doing now, the big vision, and being able to tell that story such that it's attractive.
Yeah.
Like a lot of people kind of say, hey, we're doing this, don't really know how to get to the other end, the vision, blah, 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 and kind of like muddy it a little. And like, it's not entirely that inspiring or exciting or, enticing to actually invest. And that's the other big thing that people seem to stumble on is the sequencing. And, I think you had a really interesting anecdote of like, hey, like, we built the trust and reputation that we could say, hey, we're going to make all of these lily pad jumps and see what works. Sometimes people just don't have that at the early stage, especially if it's their first business. And then secondly, it's kind of like their existing track record, maybe it's like 9 months of business building, haven't really shown that.
It's 2025. VCs are as much personal brand builders as they are useful sources of advice. How do you differentiate between VCs who are building personal brands and VCs who are actually there to help you?
I think what VC advice or even support VC advice or support should actually be is asking the questions that matter and basically challenging founders or keeping them accountable to the things that scare them. I don't think it's, opining on company building stuff or, figuring out, should you price your product $1,000 or $2,000? That's up to the founder. It's really like pinpointing, okay, this founder is really, really spiky at a bunch of different things, but they're like super scared of that one thing, and calling them out on that and keeping them accountable towards like, okay, like spend a bit more time there, like figure it out. Like you have to work through that weakness. I think that's kind of where like VC advice should sit, or, where VCs should spend a bunch of their time. And I think there's a bunch of incentives that drive VC behavior where that's not actually the case. They just kind of assume they're better than founders at like building a business, or maybe they've done it before and they just are itching to get their hands dirty, and that's just detrimental to founders.
I agree. So a lot of people ask for podcast or book recommendations on podcasts. I'm going to ask for anti-recommendations. Give me 3 podcasts that you prefer people didn't listen to when they were building a company.
Oh man. Yeah, easy. I reckon 20 VC. Diary of a CEO.
Yeah, perfect.
And I don't know, the third one's hard.
I agree with those 2, and I would add Lex to it. These are entertainment products, not advice products. You shouldn't listen to anything they ever say. Thank you.
Through the journey of Eucalyptus, like what do you think like the 1% thing that's created the biggest outsized impact for you?
So from a fundraising perspective?
Fundraising, business building, anything. Like what's something that you think is like people don't pay that much attention to it, but like actually had immense value?
I think like if I had my time again, I would, like, how I was saying earlier that most businesses are good at one thing. I would be more willing to double down on that one thing. Yeah. I think like I like kind of grew up business building in an era where it was a lot about like kind of like democratization in the workforce, kind of building really good structures for management. And I think like I actually was probably too enamored with that and like stepped out of my own core skill set too early. And what that meant is that like what I could do uniquely is kind of create oxygen for the business by like having a unique ability in a certain space. Yeah, and then my inability to stick to that actually created a whole lot of pressure on the business at different times.
Yeah.
And so I wish I hadn't done that. And so I guess like the generalizable advice is like know what your superpower is and like remain world class at it as best you can.
And is the flow on advice higher for the other things or?
Yeah, I think so. I think like also like don't premature optimize. Like there's a lot of people that will tell you at different times like, oh, you know, it's time to mature this function and that function. And like the reality is like a lot of that doesn't actually matter until quite a lot later. And so sequencing is really important there.
Yeah. Awesome. Cool. And maybe final question. What's one piece of fundraising advice that you think is commonly dished out, but actually quite wrong?
I mean, like the number one is just like people get the finances side of it so badly wrong. Like you just see these excruciatingly detailed models made up of ridiculous assumptions where people don't understand the assumptions.
Yeah.
Like the best models have like the 3 or 4 levers that are going to dictate whether or not this thing's going to work or not, and someone to talk to them really, really clearly.
Yeah, I agree.
Like just less detail and more basic first principles understanding of the levers that you need to pull, and then talk to those.
Yeah, for sure. I think like talk to those is like the underrated thing here, because every time like I go into a spreadsheet and I'm like, okay, why is this assumption the way it is? People kind of just blank and say, hey, that's kind of the assumption that gets us to like 3 mil ARR.
Don't work back from the number of the ARR number, right? Like that's so common. And it's like, and then tweak the assumptions underneath that. Like
yeah, exactly. Like back solving is just such it can work at times, but it's a big mistake a lot of the times.
Yeah. For sure.
Yeah. Thanks so much.
No problem.
Ooh. Thank you so much for listening to that conversation. I really hope that you've learned a lot and picked up some really practical tricks and tips for your fundraising process. If you're keen to learn more or get a better insight into the hidden nuances of the venture capital world, then feel free to subscribe to the Superfluid newsletter or buy my book. Both links will be in the description below.